So I wanted to introduce our two speakers today. So tonight we're joined by my mentor and Simon's mentor, Greg. Greg, I don't know if you could just wave and maybe give a quick introduction.
Yeah, so I am Greg Dickerson. I'm a serial entrepreneur, real estate developer, and investor. I started my entrepreneurial journey in 1997. Started my first company from scratch. I did not go to college. I went in the Navy right out of high school. And in 1997, I started a little remodeling handyman company with nothing. My first year, we did about 250,000 in revenues. I built that into a $30 million company in 7 years. Built and scaled 12 other companies along the way, and exited all those, reinvested all the profits in real estate, ended up doing about $250 million worth of real estate deals using my own funds, just my own deals, and then hundreds of millions with partners and other companies along the way. And now I coach and mentor people all over the country and around the world, teach them how to scale their businesses, do big real estate deals, get into real estate development, and things like that. So that's me in a nutshell.
And I was thinking about, Greg, I listen to all your content on YouTube. I binge it on the way to work on Spotify or when I get home on YouTube. So I know your story quite well. But the thing that I wanted to mention to everyone is Greg, one of the things he's really good at is making complex simple. So that's one thing I wanted to mention. I think that makes him a really good coach is, you're taking on these scary things like we're talking about tonight, investing in turbulent times, and he just makes it so simple and black and white. So it's something he's really good at. Also joined by Simon. Simon, you want to just wave and introduce yourself quickly?
Sure. My name is Simon Baylin. I actually went to school and became an endodontist, root canal specialist, and started a development company along the way. So I was building dental, medical, veterinary offices for our colleagues and decided to take it to the next step and develop real estate. So multifamily is kind of what I'm after these days, and to make that transition from building dental offices and medical offices to actually buying a piece of land, entitling that land, and turning it into units that can be rented out. I felt it was great to find a mentor, and that's how Greg and I met up. And then Pete, you and I met through Greg's Mastermind. So I'm at the point now where I'm cutting back from practice. We're looking to eventually transition out of our dental offices and focusing most of our time these days in real estate development.
Fantastic. And if anyone wants to introduce themselves in chat as well, we'd love to know who's on here, what your goals are, what you think of the current situation that's going on. So please go ahead and introduce yourself in chat. So just to introduce Baylin Development, this is Simon's company. And Simon, you're doing currently development all over New England. I know we're doing the development up here in Maine, and you have a lot going on in New Hampshire. Anything else you want to mention?
So in terms of development, we're currently building in New Hampshire, Massachusetts, and now in Maine. That's what we're doing through general contracting through my own company. Eventually, we'll move to other states where we'll hire GCs to oversee some of the actual construction. But multifamily is what I'm doing these days. And we have a 31 unit project in Maine, a 55 unit in New Hampshire, a 240 unit in New Hampshire. So several larger projects, and we're looking to pick that up, hopefully on a pace of about 1,000 doors a year.
And I'm currently helping Simon find some new opportunities in Maine, New Hampshire. So yeah, there's a lot of exciting stuff going on. So I see we think most of the people have filtered in. So Greg, I wanted to throw this to you because I don't know if anyone follows Greg, his YouTube channel, he gives a pretty good update. Greg, is it every day you're giving an update on the markets?
Pretty much every day, yeah. Global macro economic outlook on the markets, specifically stocks, crypto, real estate, and just a macro perspective of what's going on around the world with central banks and the Fed.
So with that, can you bring us up to speed on what's your thoughts on what we're currently facing here in the market, and then maybe build us up to what that means opportunity wise for those of us who want to invest?
Yeah. So, we are in a super bubble. So we've been in a super bubble in all assets, real estate, stocks, crypto, automobiles. I mean, everything has been record high valuations, record high prices, all because of the interest rate policy from the Fed and the liquidity that's been pumped into the economy over the last few years, several $1 trillion. So, it's all about economic cycles and business cycles. And the way the business cycle works is the economy runs hot sometimes. And when the economy is running too hot, the peaks and valleys of the economic business cycle, when the economy is running hot, that one of the jobs of the Federal Reserve is to balance that, right? So they're going to tighten monetary policy by raising interest rates. They want to tighten financial conditions to cool the economy off. And if you listen to the news, you hear that, that the economy, they want to cool the economy off and, bring it down. So inflation's running high, economy's running hot, employment is very low. It's putting pressure on the average income earners out there. And everybody on this, broadcast tonight can, everything you look at, prices are just through the roof. And so that's just when the economy is running hot. So the Fed has to bring that down and kind of balance that out and try to catch that middle ground. But often what happens is the economy will, they'll go too far and, they get it wrong and the economy dips into a recession where we're down at the bottom of that business cycle. So we have our peaks and our valleys. And the economy starts to slow, which is the point. They want to slow the economy to bring inflation down, but sometimes it goes a little too far. The economy slows too much, and then they have to turn around and stimulate the economy to stimulate growth. And they do that by cutting interest rates, which encourages borrowing, encourages risk taking, and things like that. So with the peaks and the valleys, so we're at the peak here, that's risk off. You're in the valley, that's risk on. And one of the most important things to know, in other words, capital looking for yield will go into risk assets, and people will take more risk in economic expansion. And when you get into economic contraction towards the valley, then it's risk off and you want to take less risk. And it's more expensive to take risk and it's more punitive if you catch the downside. So the biggest thing that you really want to know and understand is where the peak is. That's the most important thing. In any market, any asset, you always want to know where the top is. The bottom is not so important as long as you understand the top. And if you go back and look at the bubbles that we've seen over the last few years, we had a peak at 2000, 2001, at least in my investing history. Prior to that, I was a kid. I'm only 55. So the dot-com bubble was the first experience that I had with peaks and valleys. Market blew off, went into a recession, took 12, 14 years for it to come back. Then we had a big, peak run up and everything, 08, 09. And then we went off a cliff again, took about 10, 11, 12 years to come back and, for markets and, for the economy to be stable. And there were little, dips and valleys in that whole cycle, but those were your big economic cycles, 12 to 14 years, is kind of how these things run. So here we are again. And the reason we're in this situation is because the Fed started quantitative easing, meaning they were buying assets, they were buying treasuries, buying mortgage-backed securities, which puts liquidity into the markets. And they were keeping interest rates, really, really low, which encourages risk taking. And when capital is looking for yield, if they can't get a good yield in treasuries and they can't get a good yield in banks or things like that, or annuitized income, they have to go to risk assets. So that's what drives the markets. That's what drives real estate. And real estate valuations in specific are based on two things: the availability of credit and the cost of that credit. And in 2008, 9, both of those dried up. Rates went up, credit dried up, and that's why the real estate market tanked. So that's the business cycle in a nutshell. And where we are right now is we're at the peak and we're rounding over the cliff. So this is the equivalent of about probably 2008 going into 2009. And the big question is, are we going to go into a recession? How deep is that recession going to be? How long is it going to last? And what's it going to do to credit markets with what the Fed's been doing with interest rates and the pressure that the banks are under? And we don't know the answers to those questions because it all hinges on inflation. And we all know, everybody watching this, almost nothing has come down. Everything still seems to be up. Gas fluctuates a little bit. Automobiles were down a little bit. Now they're back up. Then they were down a little bit. I think, the automobile industry is kind of rolling over now just because of the credit markets that's drying up in automobile finance and people defaulting at record levels on automobiles. And then you have the commercial real estate market with a lot of commercial real estate assets, specifically office, that are underwater. It's difficult to get debt for those assets. Multifamily, residential, other real estate assets, you can still get debt. You can still get attractive debt at decent rates. We'll have Simon speak to that in a minute because he's actively securing debt in the markets right now. But we're in a risk-off environment where you have to be mindful of risk, and you have to be in preservation of capital mode and be ready to take advantage of opportunities as they come along with distressed assets, because that's kind of the cycle that we're in. And if, the Fed can manage to get inflation down, we don't go into a deep recession, interest rate policy can kind of level off, then we might be able to avoid all that. Then we get into a new norm of higher rates than we're used to and that we've seen for the last, gosh, it's been probably 4 or 5 years, since rates have been at 5%. But that's normal. In my history of investing and developing, Fed funds rate were always around 5%. And, interest rates as a developer were always in the 7 to 9% range. So to me, those were normal rates. The problem is the valuations have not adjusted to the interest rate environment. So it's going to take time for that to work out over the next, 12 to 18 months. So I'll throw it to Simon to talk about what he's seeing out there, with shopping debt and things like that.
Sure. Thanks, Greg. So we are actively seeking debt for our upcoming developments. For example, Pete and I are working on a 31 unit in Maine, which is not in the backyard that I typically build. So the lenders that I typically use, it wasn't where they want to lend. But we're still seeing rates in the low sixes, which I think for this area, it's still very competitive. A year ago, when home loans were still in fours, we were looking at 5s, 5.5, getting close to 6 in the New Hampshire area for multifamily development, which is extremely low. Like Greg said, when he was developing, 7, 8, 9% was the norm for development. New Hampshire just remains a very, very strong market, or the New England area is a very strong market. They didn't get hit as bad in 2008 as other areas, and they bounced back much quicker than other areas did. So we haven't seen much of an issue. We did have one lender who promised us cash out at the close of construction, which we're looking to take out quite a bit more than what now, even just a few weeks after. During that process, Silicon Valley Bank went out and a few other banks went out. So rather than basically loaning about 120% on the development, now she's cut it back to 85%. So 85% on loan to value of the stabilized asset at the end, which is still very, very profitable for us in terms of developers. We invest our funds at the beginning, we build a project, we stabilize it, and we're taking out funds greater than what we put in. So it hasn't hit us that hard in this area, but we have heard of other developers in other areas having difficulty getting loans.
Great. And I know one of Greg's sayings, one of my favorite is good times never last, or bad times. Is it good times never last, Greg? Bad times never last?
Either way, but yeah, good times never last, bad times never last. It's the peaks and valleys of the business cycle. And again, you just need to understand where you are in the business cycle and nail close to the top. Bottom is not that important. The top is what's most important, because you don't want to get stuck for that 10 to 12 years to 14 years that you can be stuck in the valley before you get back to even.
I know I'm a little guilty of a news article coming out like Silicon Valley Bank and feeling like, we're going down deep in recession. But and no, as Simon said, in our market here, so far, it feels like a soft landing so far. I mean, you can comment much more to what's actually going on, but I'm
the real risk, behind the scenes is the credit markets and the shadow banking industry. So loans to commercial real estate from life insurance companies, hedge funds, investment funds, private equity, things like that. There's a lot of distressed assets there, but it's not putting a lot of pressure on most banks. Some banks are under pressure in their commercial portfolios. The residential market, is, so real estate's hyper local. So every asset, every market, every city, street, place on that street, everything's different in every market. Some housing markets are red hot across the country and seeing multiple offers still and going in days. Some markets, are really falling off a cliff, and we're seeing values drop and inventories rise and days on markets rise and things like that. And to evaluate any market, the things that you want to know, the most important things are, let's just take residential, but you can, go with commercial as well. And transactions are down in commercial, in multifamily by 80%. So, it's the transactions have crashed in the commercial market and the residential market. Office and retail are almost dead. Multifamily is still transacting, but way off, levels. But for any market, what you want to know is how many properties are for sale, how long they've been on the market, how many properties are under contract, how long were they on the market, how many properties sold in the last 30, 60, 90 days, and how long were they on the market, and what did they sell for, ask price to settle price. So that's how you evaluate any market for any asset anywhere in the country. And that's how you can quickly know absorption rates, which is the key to a good market and knowing whether or not that's a good market to invest in. And, commercial is a little bit more nuanced than that, but that's just really, that's all you need. Those four things in any residential market will tell you where you're at. And, they're very different all across the country. And even markets that are correcting, like Austin, Texas, Phoenix, Arizona, there's still even pockets in those markets that are still doing well. So it's just certain, price points and certain, houses and assets in certain areas of the market that are struggling while others are doing extremely well. So, it's a really interesting time. We've never seen anything like this. There's so much going on in terms of where valuations were. So even if a housing market corrects 30%, it doesn't really mean anything because the values were so overinflated to begin with. From a natural rate of appreciation, we saw 40% over the last couple of years. That's just not normal or natural in the housing market, nor were the interest rates. So the interest rates that we just experienced over the last few years, if you're new to real estate or new to investing, that's not normal. What's normal is 5 to 7%. That's a normal range for interest rates. And the only way you get below that threshold is with creative loans, interest only, buy downs, pay option arms, things like that, to buy that rate down. But that was not a normal time. So that's a very distorted view of the markets and of investments. And there's a lot of people that got in the markets over the last few years during, after the pandemic. And, all they've seen is just the markets just go parabolic and go up. So everybody thinks everything goes up. In 2009, when I was a builder developer and I had about $30-40 million worth of product in progress and completing, and I was trying to get my permanent financing on it, when, my only experience was from basically, 1997 on, it was just everything goes up. Everything sells for more. You sell something today, you can sell it for more tomorrow. And it just went up and up and up. And we hit a little peak, 04, 05, market cooled off, pulled back a little bit, and then it shot back off to that peak in 08, 09. And, what we all learned was at the end of that, there were no buyers. You couldn't finance anything. It was really an amazing time. This is very different now because of the levels of inventory. We don't have any inventory all across the country. So in the housing market, it's a very different time. And that's why development is so exciting right now, is because there is no inventory. So builders, if they could get the labor and build is, full on for the next 10 years, they still won't be able to build enough inventory to satisfy demand. Problem is delivering that at the right price. So there's big demand in housing. There's big demand in multifamily. There's big demand in some commercial assets. But the key is going to be the availability of credit and the cost of that capital. And that's the big risk that we're facing, is credit markets really freezing up because of the hiking that the Fed's done and the capital that's getting withdrawn from the system as they reduce their balance sheet.
And Greg, that's kind of brings us to a point that you basically mentor most of us on, is make sure you have your permanent financing in place at the onset of the project. So I don't take on any developments where I'm looking at a bridge loan or a construction loan and then not sure where my permanent financing is going to come into place. Every single one of our loans, and it's just a way to mitigate risk, is a permanent loan from day one. So Pete and I, our project in Maine, has a 2-year period for the construction and stabilization at zero interest only. And then we go into 30 years of payments, but we're locked in from the beginning. We're not looking for a bridge loan and then looking to convert afterwards. So it minimizes our risk in terms of developing today.
So temporarily, and here's what happened in 08, 09. When the banks came under pressure, we had permanent financing. What the banks did was they backed out of those commitments and left us hanging on the construction loans. And that was one. The other half was the bank started calling loans. So stuff that was performing, that was doing well, the bank came under stress. The minute you close a loan, you're in technical default. So a bank can look at your loan and call technical default for any kind of number of reasons. Generally, they're not going to do that. But in 2008 and 9, when the banks were going down and they had to get the assets off their books, so they could transact, get taken over, whatever the case, when banks are under pressure, they want assets off their books. And that, those bad assets, the underwater assets, limit their ability to lend because they have to put, 1.5 times the reserves on account for, every bad loan that they have. So they just want them off the books. So they started calling loans, on developers and, other investors. So that can happen. So when we talk about understanding and assessing the risk of a project, what we mean is you need to understand what's the worst case scenario. So you got to have multiple exits, number one. So make sure you've got multiple exits. If you can, get longer term financing, at least if you're doing interest only 5 years, and the ability to refinance anytime during that. Most loans are going to lock you in with a prepayment penalty, but generally, if you refinance with them, they won't charge you that penalty. You can get a step down on prepayment penalties. If you know you're going to hold the thing, just go ahead and get some long-term debt, get that locked in, but have the ability to refinance at some point if rates come down. If you get floating rate debt, you want to buy rate caps so that the rate can only go up so far so fast. But at the end of the day, you need to look at every project from the assumption that I can't sell it. The income's not going to cover the debt service. And so I need to have reserves that's going to cover this project for a certain period of time. And if that doesn't come through, then I have to be willing and able to do whatever I need to do. Walk away, sell it, fire sale it, whatever. So in terms of what you pay for it, again, the last couple of years, people have been paying, high prices for stuff with no margin in it and no, safety net there. If they had to fire sale something, they have no cushion. So what happens in that case, if you're raising capital, you have to wipe out your equity investors and, get rid of the property. And we're seeing some of that happen now with some multi-family assets going back to the bank. So just because you have permanent financing on a development project doesn't mean it's going to be there at the back end. So you need to be prepared to carry that and, have the ability to maintain your balance sheet and all that kind of stuff so that you can, pursue other financing. But in 08 and 09, when all the banks were tanking, nobody was financing anything.
Well, we have some questions coming in, Greg. One I'll bring to your attention, but before I do, I'll just mention, if you do have, again, if you have a question or an insight, you want to come on, talk to Greg or Simon, or if you just want to put it in chat, please go ahead. Don't be shy. Greg, it's not really a question. It's a statement that I'm going to turn into a question, but someone's saying they are in Southern California. They're looking for their first real estate property. So while we're on this slide, I just wanted to throw that to you. Someone looking for their first real estate property, what do they need to understand when assessing the risk of what they're getting into?
Yeah, first thing, your goals. What is it that you're trying to achieve? Do you want to develop something and sell it? Do you want to buy something and flip it? Do you want to buy something, hold it long term? Do you want to do residential, commercial, multifamily? So the first thing is understanding what your goals are and why do you want to do it to begin with. There are tax advantages for everybody listening. If you don't own real estate, and if you're paying if you're getting a W-2 check and you're not offsetting that income through losses through real estate, you really need to be doing that and looking into that and talking to your accountant about it. And there's two ways to do it. One is passive losses, through a multifamily property. If you're a real estate professional and you can get that designation, either you or your spouse, you can use passive losses to offset active income. But if you can't get real estate professional status, then the only thing the losses in a passive investment will do is offset the income and the gains on that asset. But you can get into the short-term rental space because there is an exclusion for short-term rentals because that's considered an active investment. As long as you're actively managing, meaning like, doing the bookings, you don't have to do the cleaning or anything like that, but doing the bookings and that kind of thing, and you can show that you're actively managing, then you can do you can do accelerated depreciation, cost segregation, which they take the, furniture, fixtures, equipment, the furniture, flooring, all that kind of stuff, the personal property, and they depreciate that in addition to the structure, not the land. And then they can use that loss of an accelerated depreciation to offset your W-2 income with short-term rentals without having to be a real estate professional, because that's an active investment, like a business loss that offsets ordinary income. So those are things to look at with your accountant and talk to. But really, it goes back to your goals. Why do you want to invest in real estate? What are you trying to achieve? And then reverse engineer it. If it's an income replacement strategy, then say, okay, if I make $500,000 a year, then I need to look at assets that are going to replace that income and focus on that. And you want to focus on buying the most net income you can for the dollar you invest. And then, think about, do you want to do your own deals? Do you want to partner? Do you want to raise capital and do bigger deals? And then understand, those things. But it all starts with understanding your goals, what it is you're trying to do, where you want to start from a level of comfort, geography, what your balance sheet looks like and your financial resources, what your level of education understanding is. And then if you don't have those things, go fill in those gaps with, education, with resources, with, coaching and mentoring and whatever you need to do to get the deal done, partners, all that kind of stuff. That's what I did. That's what Simon and Peter are doing.
So I saw that person was a pediatric dentist. So my amazing wife, Mona, is on here and she's a pediatric dentist as well. And that was very important for us and how we actually met Greg. we kind of reverse engineered the lifestyle that we wanted. We know what our income was, with myself being an endodontist, my wife being a pediatric dentist, and just reverse engineer. We didn't want retirement, our lifestyle to go down in any sense. So we kind of just knew what we needed in terms of income and reverse engineered that to how many units we would have to have multifamily. We're going to far exceed that number, but we know what that number is. And for us, that was part of the goal. And also just providing housing for people who need housing. And it's also, for us, it was something, I grew up around my father's construction company. It was always nice to drive down the street and you could point to different hotels or homes or communities or apartment buildings that he built. And he would say, we did that one 84, we did that one, 89. And it was exciting to see something more than just your root canal on an x-ray. So that was kind of our why for getting into real estate development.
Yeah, we certainly need housing. I think, Simon, in New Hampshire, is it 20,000? Is that the number, or was it even higher that we need?
So it's 30,000 units currently short. That article came out last week. So they're 30,000 housing units short. But the rate at which we're building by 2030, we're going to be over 65,000 units short. So a lot of what's going on with interest rates is scaring some of the local builders. So they're pulling back. And this area, it wasn't as hot as different areas like your Phoenix and Nevada markets that overbuilt during 2008. So they never overbuilt here to begin with in 2008. And a lot of the builders pulled back quite a bit. And we're just not at the speed to provide the housing that's needed. So the shortage is, it's actually insane. So we've been able to get millions of dollars in grants from workforce housing type projects because of that. They're just trying to throw as much money at the problem as they can, just for us to build quicker and quicker. And as much money as the government's throwing at the problem, nobody's building them fast enough. So
I just Googled an article while you were talking, and the latest reports out from economists and analysts are the U.S. housing market is short 6.5 million homes. That's just homes. So they might have some multifamily mixed in there, but I think they're just talking about basically single family homes at that point. 6.5 million.
Crazy. So we're building multifamily, but if we were looking to build, I do have one project where we do have some single family. It's just that was what worked better with the homes there, but I'm more in the long-term build to hold model. So the housing shortage here is just absolutely insane at this point.
And last year there were 912,000 single family homes built. So you're talking about right there, those numbers are 6 years. That doesn't include multifamily and commercial. That's where they get that, that 10 years, that if we could deliver all the units that need to be delivered right now to kind of balance the market out, it would take 10 years. And you can't get the labor or the materials or the resources right now to do that many.
You're right on it.
Well, with that in mind, we can talk a little bit what projects work. And I have to actually mention, Greg was just mentioning tax advantages of real estate, and I didn't realize we were doing this on
tax day.
I have to
I
have to go to the IRS and make a payment after this. But I also want to mention I'm closing on a sale of a property tomorrow, and I'm under contract on a 5-year addition, what I'm doing with Simon. But Greg, start us off here. What you've mentioned a little bit about multifamily working really well right now, but what types of projects work for development or investing? Because I know we have some investors on too during.
So let's talk about the best types of assets, because these are the times when you can do really well and you can make really good moves, because there's going to be some distressed assets where you can jump in. I've got some clients that I'm coaching that jumped in right after 2011, right at the 2009 was dark. 2010 was terrible. The market just started to come back a little bit in 2011. They jumped in 2011. She was a doctor. He was a realtor. They still are a husband and wife realtor team. They're in Minnesota, their market. They started in 2011 with one house. Then they, just kind of same thing. They wanted to retire, replace their income. They didn't want to, work forever. So they started with one house, and then they, now here we are in 2023. They have 250 million in assets under management. They own, 50 or 100 single families. They've got, I think at this point, it's 2,500 doors total, something like that. I can't remember what it is, but they have a lot of units. They have their own management company, but They started after the biggest, housing decline in the history of this country, and jumped right in feet first. They've been going ever since, starting with single family, did some duplexes, quads, and got into small multifamily. Now they're developing townhouse communities and apartment buildings, and started buying bigger apartment buildings and, raising capital to do it. And, I think they retired themselves after the first 3 years they jumped in. So, housing is number one. As we saw during the pandemic, everybody needs a roof over their head. That's the one asset that is going to always be needed and remain strong. And there's a huge demand and need for it right now, whether you're building, for rent, single family, townhouse development, whatever it is. Rental units are needed. Single family for sale units are needed. Multifamily units are needed. Condos are needed. There's a lot of markets where, developers are doing really well with condos. And, when you get out of the residential market, then your next, best assets are going to be, medical office, professional office space that cannot work from home, even in a pandemic. So those are the assets that kind of made it through the pandemic. And then obviously people need food. So grocery stores and grocery anchored centers, are good assets to own. Right now, gas stations are good assets to own. The real estate's not a great business to run. It can be, but it's difficult. But the real estate, owning the real estate is a good play there. And then leasing to an operator, or owning the dirt, and then, do a land lease. And then industrial, light flex industrial. You got to be careful right now because there is some contraction in the economy, and a lot of the Amazons and, companies are pulling back with, that last mile distribution. But self-storage has always been good. It's always done well in recessions. And that, that is something that is still growing and needed in a lot of areas because the population is growing. Wherever households are added, storage is going to be needed. So those are really the top assets that you want to, get involved with. Retail can be good in some markets in some areas, but retail is very fickle and very difficult. And then office in general, is the worst segment of the market right now, taking a beating in a lot of areas. But there will be opportunities to, redevelop and reposition some of those assets and do some different things. So it's a great time to be, looking, learning, positioning yourself, getting ready, and building and preparing. There's gonna be a lot of opportunity coming down the road.
Hey, Greg, one question for a rookie. What is better, multifamily or commercial real estate in the current market? I guess that's probably going to be geography dependent.
Yeah, geography dependent. It really comes down to education. So what do you know the best? But as far and what's your business model? So multifamily right now, if you're going to do the syndication business, that's a fee business. So you're basically working for fees right there, because you're not going to see a lot of appreciation in like the multifamily syndication value add space, because rents are contracting in some areas. So it just depends on where you're at. From a developer standpoint, you'll generally, like Simon said, you're going to have that equity built into the project. So that's where the biggest margins are going to be, but that's the most, difficult, the biggest learning curve, to get into. And then, when it comes to commercial, that can be very good, especially if you're doing your own deals, like medical office, really good single tenant, type properties are really good for commercial. Self-storage falls under the commercial wing. Multifamily is actually commercial. It's anything over 5 units is considered commercial. So multifamily 5 units and up is a commercial asset, falls under the commercial class of real estate, but or the type of real estate. So it really is going to boil down to, what are your resources? How much capital can you raise? Do you want to do your own deals? Do you want to raise capital with investors? And what is your geography look like? Are you willing to travel to go look at deals and things like that? At some point, if you're going to buy a big multifamily asset or a big commercial building, you're going to kind of want to go. You don't have to, but you can hire people to do it. But generally, you're going to want to put boots on the ground and inspect the asset, or have a team member do it, especially if you've got investors. So a lot of variables there. It's really individual.
And Simon, I think this is a good question for you coming in. When initially getting into real estate development, what kind of information do you need to show? Income - assets to get qualified for loans to start construction development?
So I think that's it's going to be very specific to what you're building, or if you're buying something that's existing. If you're building something for one of your own offices, my wife and I own the real estate for our offices. It was very easy to obtain lending in that sense. You just show the lenders that you're going to occupy more than 50% of the space. They look at what your practice numbers are going to look like, and it's very easy to obtain loans. We do own a construction company that builds nothing but medical and dental offices, and we never have an issue for our clients getting them funding if they're a medical or dental professional. And we try to push some of those clients, if they're looking for a ground up build, to purchase a building where they'll occupy only 50%, especially if it's somewhere, something in the dental space. If you could put another dental professional in that building, we don't move. We build an office and we stay there throughout our careers. And that's going to be sold to somebody else. So as dentists and doctors, we're excellent tenants. We pay our bills, we show up to work. And it would be a great opportunity if you could have another professional right next door paying a large portion of your monthly note. So in terms of what you need to show the lender, in that sense, it's going to be that you're occupying at least 50% of the building, and what you're basically you're going to have a business plan for your office, and you're going to show them that. So we actually help our clients with that as well. If you're going to the multifamily space and developing at the beginning, they're going to look at your history. So it would be best if it's your first development, like Pete and I are teamed up. It's Pete's first development. I've done some construction and development. So they're looking at projects that I've completed. They do look at your financial statements, even though we're looking for loans where we're not signing as the guarantor. If you are signing on the guarantor or you're not signing the guarantor, they're still going to look at all of your personal assets. So I hope that answers that question. Anything that you want to
So let's break that down a little bit. Number one, doctors and dentists, medical offices, that's the lowest default rate and the easiest to get financed and the easiest people to get financing. So, you've got the cream of the crop right there and the easiest path into real estate. So in terms of what's required, so if you're going to do development, so the one thing you got to understand is the entitlement process. Getting a piece of property through the entitlement process and getting it improved is not cheap. It can cost you, $100,000 for a small building to hundreds of thousands for a big development. So somebody has to have that capital. Real estate development requires deep pockets. It doesn't have to be yours, but it's got to be somebody's. You need a lot of upfront money, to get a project through the pipeline and permit ready. And then, you can get to the bank and get your startup funding from there. And then the bank's going to want to see, like Simon was saying, Simon says, the bank is going to want to see your balance sheet. So you're going to have generally a balance sheet, equal to or close to the balance of the loan. The bank's going to want a deposit relationship with you. Generally, so the banks that you're banking with, a lot of times will be good candidates because you're already doing business with them. So those are the things they're going to look at. Obviously, your credit. They're going to look at your experience. If you don't have experience, you have to have an experienced team, and then you can bring somebody on as a key principal in your deal that has that experience, to help you qualify. But if it's your own building, they might let you get away with that. But if you're doing something else, then, they probably won't. And then, the last thing in terms of loan guarantees. So you have to guarantee the loan. You guarantee every loan. You're going to sign on that loan as a guarantor. The difference is whether it's recourse or non-recourse. So that's the difference. So it still requires a loan guarantor. Okay. And that's, if you don't have the balance sheet for it, you get what's called a key principal, and they come sign the loan for you. But it's either recourse or non-recourse. It's not, no guarantee or guarantee. You're going to sign on that loan, you're going to guarantee it, but it's going to be non-recourse. So that means the only recourse they have in default is they take the property back. And then they have what's called bad boy carve outs. And as long as there's no bad boy carve outs, they just sell the real estate, they write off the deficiency, and they don't come after you. But if you personally guarantee it, then they're going to come in and they're going to, go after you for any deficiency in the event of a default and pursue you for that difference. And then, you can have a corporate guarantee instead of a personal guarantee. Then the corporation is what's liable, and you can put the assets up and all that. And, you risk losing the FF&E, in the building or whatever if you do that. So that's what it requires in terms of getting financing, getting started. And, so you got to have some capital to get going, but it doesn't have to be yours.
And somebody mentioned private versus national lenders. So for development, everything that we're doing right now is local smaller banks. And as Greg mentioned, it's because we have a relationship with them with funds that are on deposit. For dental offices, I've done it both ways. We've used local banks and we've used national banks. I don't see on that end, it doesn't make much of a difference. I built several dental offices. It doesn't matter to me whether I'm working with a local bank or national bank.
Yeah, so private lenders are different. So if you say in private lender versus a national or regional or bank or whatever, so a private lender is going to be an individual, or it's going to be a company that raises money from individuals and then loans their money out as private lenders. And that can be a very good source, but it's going to be expensive because they're just taking money from investors and they have to mark that up. So they have to give the investors a return and they need to mark that up so they get a return, and they're going to add points to that so they can make fees. So there's hard money, there's private money. Hard money is different where there's going to be bigger points up front, there's going to be bigger interest rate, and those are good for short-term loans. But when it comes to development financing, you can get some private lending to do those deals, but it's going to be more expensive than a bank. A bank is going to be your cheapest financing, but private lending can be easier to get. So they won't necessarily require the experience from you if you've got an experienced team. They won't, they're not necessarily as strict or as stringent as banks are going to be. So hopefully that answers that question.
Yeah, I think it definitely does. We have a couple others I'm going to save till the next slide, or maybe to the end. I did want to mention, if anyone, as we go on to the next slides, if you want to jump on, introduce yourself and ask Greg and Simon any questions, we'd love to have that as well. But Greg, so I think we have 2 more slides, and these 2 last ones you made sure I put them on here. So take us through this one. Should you even do the project? What goes through your mind on this one?
Yeah, so it's all about feasibility. So again, it comes back to your goals. So number one, the project has to work. It's got to be feasible. In other words, it has to be able to make a profit. And when you're navigating the business cycles and mitigating risk, you want to make sure that when you're in a accelerating market, you can take a little bit more risk, you can be a little bit more aggressive, and you can lead the market up. So if you sold something for X amount today, you can sell it for more tomorrow when you're in a rapidly growing, accelerating market. If you're renting something for so much today, you can rent it for a little bit more tomorrow. But you got to understand there's going to be a cap and there's going to be a peak, and it's going to roll over as the business cycle changes. So when that rollover happens, you want to reverse that strategy and lead the market down. So you need to look at deals from the standpoint of, in any environment, you can always do a deal. There's always opportunity in every market cycle. And when you're on the downside, you want to lead it down. So if you sold it, at 500 today, you got to plan to sell for 450 tomorrow. Sell 450, tomorrow, sell for 400 the next day. Rents the same way. As we get into recession, people lose jobs. You got to look at where your assets are, who are the employers, what do your tenants look like, are they at risk? And if they are, you need to understand that. And as you're looking at a project to evaluate, underwrite that project from the standpoint of the local market, who the tenants are, who the buyers are, what the market's doing, what the interest rate environment looks like, and where we are in the business cycle. And then that will tell you whether or not that specific deal or project is feasible. And you can do that in 5 minutes. Really, you can look at a deal and underwrite it to the point of feasibility in about 5 minutes to decide this looks like it's going to pencil or it doesn't, just from an economic standpoint. Then you go into the deeper levels and start looking at markets and all the different demand drivers and things like that.
Well, I think one thing on development is, does it pencil financially, but also is the town going to let this happen? Is this actually going to happen on this piece of land? So should you even do the project because of the time investment due to the nature of the land and what it's going to take through the pre-development phase?
Yeah, that's stage 2 of the project. Is you want to so number one is what so you have to determine highest and best use. Is what you want to do right for that property? Not every property is right for every use. Not every use is right for every property. So you need to determine highest and best use. What's the highest and best use of that property? And we can't get into that tonight because that's a long discussion. But you can hire an appraiser. A CCIM commercial appraiser that can give you that report if you've got a really good property. But it all comes down to demand. What is the market missing? What are the needs? What's the demand drivers in the market? That kind of helps you get there. Then you want to check, obviously, zoning. Zoning is going to tell you what the allowable uses are. And do you need a conditional use permit, special use permit? Do you need to rezone? Does it need annexation? What are the conditions? Because that's going to tell you your timeline. The more hurdles you have to jump to get something approved, the longer the timeline is going to be. And then, you want to do a project in a, friendly environment with a municipality that, wants what you're doing, because if they don't, it can be a battle. And it can be a problem. And I think, Simon, were you coming up against something like that on one of your projects?
We had a historic cabin that the town didn't want taken down, and the previous developer fought them for 8 years, and then Mona and I fought them for a year, and finally Mona stood up at one of the zoning meetings and got it taken care of. So I'm sometimes a little bit too nice. She wasn't very nice with the last person who was opposing it. We finally got it signed off. That was a few months ago. But even Pete and I just went through that on another project. We actually had a P&S on. It would have been a great 100-unit project. The only issue was the access road required us purchasing one of the two homes, either to left or the right of the current access road, because it was going under some power lines. And other people have tried to develop that. Nobody wants it developed in that town or in that specific neighborhood of that town. So it was a no-go. It just, even though the numbers, everything penciled out, would have been an excellent development, would have had great returns. But if you can't access the property and the two neighbors just don't want the development there, just time to move on.
Yeah. So should you do the project in, difficult economic times, uncertain times? Absolutely. If it meets your requirements, if it returns on the investment you're looking for, services the debt, you have multiple exit strategies, and you can carry it through, an economic downturn. Absolutely. Don't wait if you can get it going and it's, meet your goals and satisfies what you're after.
Question from a new member of the dental developer group, Jenna. She asks, would you advise purchasing out of state? And which states have you found to be best to look at for commercial or residential properties?
Yeah, so the best markets in the country are the Southeast markets. Your Texas, Florida, South Carolina, North Carolina, Arizona, Nevada. Those markets are doing pretty good still. Some pockets, but it really depends on what you're looking at. So the last thing you want to do is go, like, there's these turnkey rental property companies where you can buy like cheap houses in Indiana, for 100 grand, 50 grand, whatever, and it's turnkey and they got a tenant and all that. Those are a nightmare. Don't buy cheap houses out of state. Those are very difficult unless you have a really good company that they've been in business for a long time. They've got great references, and that's what they do. But people get burnt all the time, buying cheap out of state rentals. Now, vacation rentals are great. Short-term rentals, buying those out of state in resort markets. The short-term rental market is correcting because during the pandemic, you could put an Airbnb anywhere and it booked. Literally, you could stick one in your backyard and people would come stay there. But now, people are traveling abroad again. So the world is open. So people are traveling globally now. So the Airbnb market has taken a big hit. So these houses that weren't in great, tourist destinations where there's attractions and, things that people are going to want to go do and see, those properties are suffering. So you can buy those in good markets, beach areas, resort areas, mountain areas. You want to look where you can get the most income year round, so that Florida market's really good for those. If it's commercial, it just depends on what type of asset it is. Those are the commercial and multifamily and vacation rentals are the easiest assets to own out of state. And, if you have a market that you want to buy like single family rentals, like a Charlotte, North Carolina, Raleigh, North Carolina, down in markets in Florida, buy nicer assets that are going to bring in a little bit higher paying tenant because you have less trouble with those generally. And, it's easier to get management companies and things like that. When you have those cheap rentals, there's just a lot of trouble that can happen with those. So those are the kinds of things that you want to look at.
And Greg, this next question brings up something that I failed to mention. You work with a lot of dental professionals, not just on real estate development, like you worked with Simon, or real estate investing, but you also help with their practices and growing their practices as well.
Yeah, helping them scale their business. And, a lot of what I find is doctors and dentists, it's the leadership management component of scaling your business. So that's what I really help a lot of people with, is putting their business systems in place, their, leadership systems, how to get the most out of their people and, things like that. And yeah, I work with people all over the country doing all kinds of things. And that's as people grow their teams and scale, that's a big, topic of conversation, especially right now with, such a tight labor market and such a difficult employee, out there. How do you manage, how do you lead, delegate, motivate? How do you become a real estate developer? How do you become a real estate investor? How do you become that entrepreneur that, inspires results out of your team without you being there? The true mark of a great leader is how well your organization does without you there. It should do better without you than it does with you. So if you find yourself just stuck in the day-to-day and you can't get away, you've got some issues there that you have to deal with. So that's a big thing that, I help a lot of people with.
The question that sparked that is someone's asking, how do they join the Greg Dickerson Mastermind?
Yeah. So my website, you can go to my website and check all that out. I've got some real estate courses there, and coaching program is on there as well. And yeah, I've got a lot of medical and dental professionals. I've got professional athletes, builders, investors. I have people, all around the world. I've got a young man in the United Arab Emirates, and he's got 7 different companies. And that's what I'm helping him with is, his leadership and finding the right people, getting a CEO, COO, CFO, and all his different division leaders, and, getting that thing dialed in. So it's, it's a common thing all around the world.
So this last one, this was the one that you jumped off and said we definitely need to include this as the one to close out. So what do you need to know so you don't lose all your money? So what are the quick tips here?
Yeah. So you need to know what you're doing. So there is no substitute for education, but if you don't have the right education, surround yourself with people that do, like Peter and Simon did. Peter had never done a development. He had an opportunity. He went to Simon and they partnered. And, of course, I'm coaching them and mentor them as well. But, number one, it starts with education. Know what you're doing. Know your craft, know your market, and, know exactly what you're doing. Don't risk more than you can lose. So that's a real big one. A lot of people will just, when the market's doing well and interest rates are low and everything's going, everybody can get caught up in the last few years thinking everything just goes up. Remember the business cycle, peaks and valleys, peaks and valleys. So, you never want to invest more than you can lose. And you want to make sure that you understand the peak of the market cycle, where we're at, understand the cost of that capital, and understand, the worst case scenario and what can go wrong, and be prepared for that to happen. So if things turn, your real estate, your businesses, whatever, become upside down, have a plan and say, okay, if the worst thing happens, I've got X amount of dollars that I can carry things. But if that doesn't correct or fix, at some point you got to pull the plug and you got to start selling stuff. You got to start closing stuff and selling stuff. So, you want to make sure that you understand that, good times never last, bad times never last. And, you want to have a plan in place that if things do turn, for the worst, you want to make sure that you don't carry it too far thinking you're going to come out of it. And you don't want to hang on and chase something and keep throwing money at something that's not working, when the best thing to do sometimes is just, shut it down, sell it off, and move on to the next thing. A lot of people will hang on to a real estate deal thinking that, they're going to get a huge price. The market shifts. They miss the market because they didn't identify the top. And then they can't get out of it later, and they hang and hang and hang, and it wipes them out. So cut your losses. If something's not working, get out of it quick, move on to the next thing. You'll make it up on the next deal. But it all goes with education. You have to be a master at your craft. You got to know what you're doing, or you got to surround yourself with people that do. So if you're a great communicator and you know how to raise capital, then go find somebody who's a great operator, that can get the job done. If you're a great operator, but you don't like dealing with the other, go find somebody that can fill in that gap, and you can partner with them. You can hire them. You can joint venture with them. A lot of different ways to do it. That's how I got started. I didn't know how to build a multi-million-dollar house before I did. I hired people that knew how to do it. I put them in the right spot, and I coached them to success.
Well, that's fantastic. We have one question, and I'm not sure what this acronym is. Thoughts on a DSO, build and own property business? Are you familiar with that term, Greg?
So the dental service organization.
Oh, okay.
So DSOs are somewhat taking over the dental space. It's larger corporations that own several offices. And in terms of owning so my wife and I kind of were on that path to opening our own small DSO and owning all the real estate. And then at one point selling the offices and keeping the real estate for our retirement, which is kind of still our plan, even with the offices that we do have. A lot of the DSOs right now, when they're acquiring practices, they want nothing to do with the real estate, which is very interesting to me. Why they wouldn't want that, but I guess it kind of makes sense if your business is dentistry, why get into the real estate, or vice versa. When these DSOs do come on and purchase your practice, if they're going to purchase yours, and you have a $1 billion company or several $100 million company now signing on the loan, the value of your asset, your real estate, actually goes up quite a bit because you're no longer an owner occupier. So now the banks evaluate that property a little bit different. So if you're going to start your own DSO and own all your real estate, I think that's a great play. But I would probably sell that real estate. If at some point you're going to combine with another DSO, I would probably sell the real estate a few years after. We're looking at different options of transitioning out at some point. And most of the DSOs are looking for a 10 to 15 year lease when they're purchasing. So I'd probably sell the real estate 2 to 3 years after they're in, because the worst thing that could happen is they take over your practice and they run into the ground. I've seen that happen in a couple of DSO transitions. But the best thing is they stay for the entire 10 years and then they want to move. Hopefully they don't, but you don't want to be stuck at 9 or 10 years looking at what to do with this property at the end. Try to sell it when you still have some upside there.
Yeah, and the key is keep them separate. So all your real estate assets, you want to keep those separate in separate LLCs, separate entities. And then, the DSO is a tenant, your practice is the tenant, all that. So keep everything separate so the one doesn't affect the whole. That's another way to not lose your money. Asset protection, and we don't really talk about that, but if you don't have an asset protection attorney, you really need to get one and make sure that you're structured, in the best possible ways legally. And from a tax standpoint, you should have an accountant that's sophisticated in all these things. You should have a tax attorney, and you should have a estate and asset protection attorney, and have all those protections in place so that you're sheltered and you don't lose your money because of an accident or whatever. And then you keep all your assets separate, so one business has a problem, it doesn't affect the other businesses. All of that.
Well, that was fantastic. We are right on schedule, and we kind of just brought the questions in as we went along. If anyone has any final questions they want to throw into chat, now's the time to do so. I just wanted to thank Greg for taking the time to join us today. Make sure to subscribe to Greg's YouTube channel. He posts a lot of great content almost daily. Head over to dickersoninternational.com. You'll have all his courses. He has courses on development, entrepreneurship, real estate investing. And he also has his Mastermind program Simon and I are in, and his information on one-on-one coaching. Also, I just wanted to mention, most of us are in the Dental Developer Facebook group. If you're not, join. And I just wanted to kind of plug out there. Let's all engage, and if you have questions, make sure to ask them. If you have wins, share them. If you have failures, share them. We're not gonna make you feel bad. So it's a really great group where we're all have the goal of learning more about real estate development and real estate investment. So the more engagement, the better. We're gonna have a couple events every month. One is Pints and Properties. That's our virtual happy hour. So that will be coming up in May, and then we'll be having another webinar as well. So Simon and Greg, I just wanted to thank you both for doing this.
Thanks for having me, and enjoyed the time. Good questions, and get out there, join that group. And the whole point of this and purpose of this is for you guys to connect with each other, help each other out, fill in those gaps like I talked about. To come together so you can do bigger deals, more deals, get your own deals going, whatever. There's a lot of people in that group that are doing deals that can support you and help you along the way. So this is a great time. A lot of opportunities out there. Get that education, get out there, start looking at deals, making offers, and taking stuff down.
And Greg is actually very active in the group, which is great. So I mean, if you post something, you might get even an answer from Greg. So thanks for doing that, Greg. And Simon, thanks for taking the time to do this as well.
Of course. And Greg, again, thank you so much for joining us. I think we had one question from Serene. If it's your first deal, why would the banks ever lend to you? And I think that comes back to Greg's point. You want to start by educating yourself and then surround yourself by other people. So even though it might be your first deal as an investor, it's not the first deal that the people in that group have put together. So if you're somebody like Greg said that raises capital, or you have some other attributes you can bring to the table, you can definitely get into a development or get into a real estate deal. And the bank's not going to look at your experience or lack thereof. They'll look at the group as a whole.
Another point to that. So that's development. So on acquisition, so if you're buying an existing asset, then they are looking at the asset, not you. Not single family so much, but there are what's called DSCR lenders, debt service coverage ratio lenders for residential. But on commercial, they're looking at the asset and the income the asset produces. And lenders that lend on short-term rentals, the same thing. So they're going to qualify you on the asset. Now you still have to have good credit. You still got to have some, financial resources and things like that. But if you're a doctor, dentist, you're making, 300, 500,000 a year, whatever, you're going to qualify and they want to lend you money. So the answer to your question is you're a good client. Banks are in the business to make money by lending money. And if you saw the reports, if you followed the markets, Goldman Sachs, JP Morgan came out, record earnings because interest rates, Bank of America, record earnings because interest rates, they make money by putting money at work. They're looking for good borrowers. So they want to lend you money. So that's a big fallacy that a lot of people have. A lot of people think the banks are an enemy or whatever. No, the banks are looking for you. You're the best borrower they can have because you have clients, you have a business, you have the lowest default rate on loans for real estate. So they want you as a client. So get out there and take advantage of that while you can, because it's, especially right now, because their credit's tightening for a lot of people, but not for medical professionals.
Excellent. Again, thank you guys for joining us. We love having you here. Pete, thank you so much for helping with all of behind the scenes and making all these work. And Greg, thank you so much for coming on again 2 weeks in a row for us. Really
Yeah. Thanks for having me. Everybody, thanks for joining, and y'all have a great rest of the week and upcoming weekend.
All right. Take care.
Bye, everyone.
Bye-bye.